Today, how will home lending growth play out? Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. One of my clients asked me to share my thoughts on the trajectory of future home loan growth in the light of current market dynamics. So today, we're going to look at the results. And by the way, if you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. And here is the link, and it's also in the comments below. As you may know, we run a series of lending growth modelling in our core market model, and it's updated each time we get data from our surveys, from APRA, ABS, and RBA. So I included the latest data from the ABS in terms of lending flows, factored in deep discounting and rate cuts from some lenders like ANZ, and the ability of some lenders like Macquarie, HSBC and some credit unions to fly higher than the APRA imposed cap on investor loan growth. In fact, we run three scenarios: a base case, which we'll discuss in a moment, an aggressive growth case, and a lower bounds case. We've assumed no move in the RBA cash rate over the next 18 months, a continued fall in the pressure on the BBSW rate, and some continued momentum from first-time buyers. And we also factored in the ongoing shift from interest-only loans to principal and interest loans, and the appetite for finance from some household sectors, especially those seeking to refinance, including those seeking to assist their offspring to buy via the bank of mum and dad. Our model has been tracking close to the RBA data in recent months, so we're pretty confident about the trends. But it is only a projection and it may be wrong. The first chart shows the overall value of housing loan portfolios split between owner-occupied and investor loans. The astonishing momentum in investor lending up until the mid-2017, when APRA's new regulations kicked in, then eases back, and the current growth in investor loan portfolios is pretty flat. In fact, we expect a small rise in the months ahead as some non-bank lenders have to compete harder with the APRA-approved lenders who can go above the cap. Remember though that lenders still have tighter underwriting standards than before, so there is not going to be a massive resurgence in my views, at least until the Royal Commission reports. Owner-occupied loans will continue to lift as first-time buyers are still active and attracted by the lower property prices. Refinancing of existing loans does continue, although some are having difficulty finding a loan, as we discussed yesterday. Turning to the percentage change, our base case is for a slow rise in investor lending and a slow fall in owner-occupied loans, with an overall growth still well above inflation at between 5 and 6%. This suggests that lenders will need to compete hard for the business which is available, continue with more rigorous loan assessments and manage tighter margins as a result. So we think property prices will continue to go lower through 2019, but it does not yet signal a crash. This could all change if funding costs go higher, or the banks get slugged with more costs relating to poor practice, or even face criminal cases relating to charging fees for no service or making unsuitable loans for borrowers. As a result, there is significantly more downside risk than upside gain at the moment. Our worst-case scenario actually sees the overall lending portfolio shrink, and if that were to happen, then all bets are off, and we must expect significantly more property price falls through 2019. Actually, we don't think, as some are saying, that the worst is over. Rather, it's just the end of the beginning. And finally today, mark your diary. The next DFA live stream event will be on Tuesday the 21st of August at 8 p.m. Sydney time. I'll be providing more information shortly about the event, but it's already scheduled on the channel if you want to set a reminder. And feel free to send questions in beforehand. If you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. The link is in the comments below. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you've already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.